Today, the Reserve Governor and the board met and they kept interest rates on hold. So the cash rate remains at 1.75, leading into the federal election on July 2. Now, there's a couple of things I want to talk about. Firstly is negative gearing. So we know that the Liberal Party is not making any changes to negative gearing, but the Labor Party are proposing changes to negative gearing. And even though we're apolitical, it's really important to understand what these changes will do to the property market, but also the economy as a whole. Now, 1 in 4 jobs in this country relate to property. So it's been a very important part of the transition that we've been making away from the mining boom. And it's been the reason why we've seen good, strong economic growth. And I'll get back to that in a minute. But in terms of the policy, what Labor are proposing is changes to negative gearing whereby it's only going to be available on new property. And they're also going to change the capital gains provisions, which will mean you'll pay more tax if you sell your properties. Now, the problem with this policy is it's going to encourage the building of high and medium density accommodation, which is not necessarily attractive to both owner-occupiers or also tenants. In addition to that, it may also attract mass building on the fringes of the city, which is going to affect property prices. So it's my belief that this type of policy will actually see values of properties drop in that particular category, and it'll make land very close to the city very expensive as people look to knock over existing homes and build townhouses or duplexes. So it's not good policy. So that's why we don't support changes to negative gearing. So if you're an investor, it's important to have this conversation with yourselves and your family around what this could do for the wealth in your household, and to also make sure that you can see the long-term challenges of such a policy. Now, I want to get on to the economy. The reason why changes to negative gearing could impact the economy, as I mentioned before, 1 in 4 jobs are linked to property. So we're seeing this transition occur, and we've actually seen some good GDP numbers. So for the first quarter of 2016, we had growth in GDP of 1.1%, which led to an annual increase in the GDP of 3.1%. But even though that's a great top line number, if you dig down deeper into the layers, we've got some problems. And what GDP measures is actually revenue. So it measures the amount of revenue generated over that quarter period, and increase on the increase before is how you get those GDP increases. Now, it's all good to have revenue increasing, but what we've got is a challenge. So we've got all this export, we're exporting this iron ore, we're exporting this gas, but the value of those commodities has come down, which means that even though we might be generating greater money or revenue, what's happening is the income or the margin or the profit that we're generating is actually lower. So it doesn't actually benefit the economy in the sense that the tax revenues being received by government. In addition to that, we also saw in the last GDP quarter numbers is that business investment is continuing to fall. Now that's coming off the back again, and I sound like a broken record because it's coming off the back of the mining capex that's no longer occurring. So we're not seeing small business and medium-sized business pick up that slack because profits are falling. So if we saw the last round of profits announced on the share market, we saw that the margins and profits are actually slowing down. And that's leading to also no income growth. And so we're not seeing incomes grow dramatically. So we've got this situation where we need to look at 3 critical things moving forward. We need to look at business sentiment and confidence. We need to look at consumer confidence. And finally, we need to look at consumer spending. Because what is happening is if consumers aren't out there spending, this is where the deflationary number comes in. So the RBA doesn't want to see deflation because what it means is that basically the economy is going backwards and confidence will start to slow and people will spend less. And this also comes back to the negative gearing point. If people feel that the value of their homes is going to be less, it's called the wealth effect. And what it means is that households will say, I'm not feeling as confident about my position, my job, the wealth in my household, so I'm not going to do that discretionary spending that I was doing before. So it has a flow-on effect. Now, this is dangerous for the short to medium term in our economy, and we could be heading towards potentially a recession. I know that's a big statement, but I reckon there's chances that we may be in recessionary pressures, and what that means is 2 negative quarters of GDP in the next 12 to 18 months. So the Reserve Bank is very conscious of that, and that's why there's commentary around a further rate cut in August or September. And this comes back to this whole point around the economy is not as strong, people aren't as confident, and if you want to put a sledgehammer into that, changing negative gearing is going to do exactly that, where confidence will drop dramatically. Because once people work out that these high and medium density high-rise accommodation apartments and house and land packages on the fringe of town aren't worth as much in terms of the investment returns anymore, it's going to dry that confidence up and dry that building up. And when you've got, all the developers, all the HIA and all the big associations in terms of the Property Council of Australia all saying it's a bad idea, and people might say that that's self-interest, but the reality is they know. And you'd think that developers who are going to get a boom in terms of a so-called boom, if it was all going to be on new stock, they think this is going to be great for us. They're also saying no, because it means that the secondary market is going to be a disaster. It's going to be like buying a second-hand car where the value of that new car drops dramatically as soon as you drive it off the lot. So we think it's poor policy, okay, in this particular circumstance. We think there does need to be some changes made around a broader spectrum on taxation, and we would say that negative gearing needs to be in that mix in terms of the overall scenario of a tax reform, but on its own, and this policy is not actually smart policy at all. So that's why we're anti the changes to negative gearing. So we've got a big decision to make on the 2nd of July, in terms of how the economy is going to move forward. We are transitioning. So far we've transitioned fairly well, but those changes and sort of playing around with the economy can have a dramatic effect in terms of our economic prosperity, and that's going to flow on to in terms of household wealth. So it's a big decision to make. I hope you make a smart decision.